Friends, I welcome you all to our today's session. This session is about trading mechanism. So we'll try to develop a very basic understanding about trading mechanism in a secondary market. And when I say secondary market, it refers to stock exchange. Stock exchange is the place where these outstanding securities like equity shares, bonds, etc., which are already issued and which are listed in exchange are traded. People buy and sell those securities in a stock exchange. So that offers us a platform. If a security is listed in a stock exchange, then it can be freely bought and sold. Otherwise, also, the shares of a company is freely transferable. It can be bought and sold also. But listed securities means this can be freely bought and sold in a stock exchange platform. Yeah. Now, let me share the screen with you. Let us have a look at the presentations that we have. Yeah, first let us try to understand. You must be having some idea what are the various stock exchanges are there in our country. Do you have that idea that how many stock exchanges are there in our country? Can anyone tell me? Can you name some of the stock exchanges?
Sir, Bombay Stock Exchange.
Good. One is Bombay Stock Exchange.
National Stock Exchange.
National Stock Exchange.
National Stock Exchange. Then
Over the
okay, let us check this. So how many stock exchanges are there as of now? So you might be knowing there are various stock exchanges. Almost roughly, if you say, if you just name one, if you think maybe around 20, 23 or 24 stock exchanges may be coming to your mind. But if you go to actually, if you see whether actually their license is valid or not, we have to check. Okay, you might have heard there is a stock exchange at Bhubaneswar, there is a stock exchange at Patna. Like this, many places stock exchanges are there. But how many of them are actually operational? If you want to know, then what you have to do, you have to actually visit to the SEBI website. You have to see the website of SEBI and find out what are the stock exchanges which are actually operational as of now. So I'll do one thing. Let me take you to the SEBI website. Give me a moment for that. Let us check right now so that we can have a primary understanding that these are the stock exchanges actually operational in India as of now. Just give me 1 second. Let me search it. You can find it in SEBI website. Okay. Just you yourself also can try. Yeah, I could find it here. Are you able to see it now?
Yes, sir.
Oh, you see.
Yes, sir.
If you see the SEBI website as of now, today, you are finding out, you see, only these 9 stock exchanges are there, which are active. You see, BSE Limited, it has got, you can see the permanent recognition. Calcutta Stock Exchange is also having permanent recognition. India International Exchange, it has got recognition up to this. That means recognition is expired, right? Okay. Indian Commodity Exchange Limited, permanent. Okay. Metropolitan Stock Exchange, you can see it is got recognition up to 22. Multi-Commodity Stock Exchange, permanent recognition. National Commodity and Derivative Exchange Limited, permanent recognition. National Stock Exchanges of India, permanent recognition. NSE IFSC Limited, permanent recognition. Not permanent, it is recognition is valid up to May 28, 2021. It is already expired, right? You see, so as of now, if you see, this is 1, 2, 3, this one is 4, maybe 5, 6, 7. Okay, 7 exchanges are there which are operational. Okay, you can see, and also it says what are the segments in which they can trading can be allowed. Let us say for Bombay Stock Exchange, equity derivatives, currency derivatives, commodity derivatives, and debt. The previous classes we have visited Bombay Stock Exchange, we have already seen that these things, these kind of instruments are traded there. Okay. Okay. Got some idea?
Yes, sir.
Just a minute. You can go through the notes. It talks about what are the stock exchanges which are already expired. You can here you see Bhubaneswar Stock Exchange Limited, Jaipur Stock Exchange, OTC Exchange Limited, Pune Stock Exchange, all this thing. They have been granted to exit by letter number. This thing, this note also you can read. Other stock exchanges are not in operational, like Hyderabad Stock Exchange, Coimbatore Stock Exchange, Surashtra Koch Stock Exchange, Bangalore, okay, Cochin, Bangalore, Ludhiana, Bhubaneswar, Jaipur. You can read this note which I published in SEBI. Okay, this will give you the actual fact that how many stock exchanges are out. Okay, so don't say that it is just NSE or PSE, other exchanges are also there. Okay, friends. And when I say that, we'll be understanding the trading mechanism, the process of trading in the stock exchanges. We are referring to these stock exchanges which are called as recognized stock exchanges. Okay, right? Or RSE, you can say recognized stock exchanges. Now, once again, let me share the PPT with you. So, you know, stock exchanges are a very good place, or a proper place, a proper platform for creating wealth. People visit stock exchange, or people do trading in the stock exchanges with their intention to create wealth. Of course, many people come there, some people gain, some people lose. As you must be having this idea that every stock price, or for that matter, if you refer to the Sensex also, or various indices, you must be knowing that their value fluctuates. Yes or no? Whether that value keep on fluctuating or they remain stagnant. Do they fluctuate? At any moment, if you see the stock exchange, you can find price keeps on fluctuating. When price keeps on fluctuating for anything, whenever or any asset, whenever there is a fluctuation in the value, fluctuation in the price, that itself indicates that there is a risk when you make investment. Right? There is definitely a risk because you don't know what will happen today. Let us say you have purchased something at 10 rupees. Tomorrow it will be 12 rupees or 8 rupees. You do not know. Because price will keep on fluctuating depending upon the demand and supply situation. And when a product or an equity share or a bond is listed in a security, and every moment this demand and supply position keeps on changing, and that affects the price. Whenever there is more demand, then price goes up, and whenever there is low demand or more supply, that means more people are interested to sell and less number of people are interested to buy. What will happen? Naturally, price will go down because that will create a selling pressure. So buying pressure moves the market up and selling pressure brings the market down. And this ups and down movements in the price brings a risk. The moment you are investing at a particular price. And you are not sure that after that the price will go up. That means you are not sure after that whether demand pressure will be more, supply pressure will be more. Therefore, there is every possibility that you may lose money. Therefore, what is desirable? So, as a prudent investor, what is desirable is that you need to follow a kind of disciplined approach to invest money in the stock market. There are various ways, various systematic approaches one can follow. Maybe in some other paper, your portfolio management or security analysis, you might be learning these things. But today we are not learning all that thing, but are the various approaches and all. But we'll be only understanding the basic mechanism, how trading can happen. So various products are traded in the stock market. It is the common platform to trade all these products. Just now we are seeing the SEBI website, and you have seen that, let us say, talk about Bombay Stock Exchange, various products like equity shares, bonds, derivatives, forex derivatives, all these things are tradable in that platform. And when investors join there, investors who wants to invest money, all of them expect return, and the return expectations are different. Suppose you might be expecting 20%, someone might be expecting 18%, someone might be expecting 30%. Right? The return expectations are different. Return expectations are different. At the same time, you have to understand that their risk appetites are also different. They are ready to accept different level of risk. The risk that you want to take, somebody else may not be willing to take that much of risk. Okay, so when they take an investment decision or they take a decision to dispose of an asset, to sell an asset, they do it because they compare their expected return with the risk they are ready to absorb. On that basis, they take a buying decision or they take a selling decision. Okay, there are some people which we call them investors. Investors means normally they invest for a relatively long-term basis. They invest some money, they expect that over a time value will go up. And there are some people who do only intraday trade. That means maybe at 10 o'clock they buy it, 11 o'clock they will sell it. 10 o'clock, let us say they have bought it at 10 rupees, 11 o'clock they can sell it at 11 rupees. 1 rupee is the profit. So depending upon the volume, so with that 1 rupee profit, if the volume is more, let us say they have 10,000 shares, so they can earn 10,000 rupees per day. Possible, but they can also lose 10,000 rupees. And there is also possibility that today you earn, tomorrow you earn, like that you keep on earning for 1 month. And at the end of the month, you may lose the entire thing also. That possibilities are also there. So what I want to focus is that it is a platform to create wealth, but it is a platform where a lot of risk is involved. And the stock market is only an intermediary which helps you to attain your objective of wealth maximization. But you should know what is the risk, what is the level of risk you are going to take. Coming to the constituents, that means who are the people involved in the stock market. As you know, every market, there will be definitely some buyers and sellers. There will be some people who will be willing to buy, and there are some people who will be willing to sell their security or any asset. But in stock market, since so much of risk is involved, and this is a different kind of asset, or there are different kind of assets which are dealt in the market, people may not be able to understand what are the risks, what are the returns associated with those assets. So this market needs to be controlled. Therefore, various authorities are there to control the secondary market. So first thing is that the Security Exchange Board of India, or SEBI, is the regulator of that market. It supervises. Stock exchanges, they have their own rules and regulations. On that basis, trading happens. So they are, you can say, one more participant in the stock market. Broking houses or brokers are there through whom the trades are executed. They are also market participants. And there are traders who buy and sell securities more frequently, and there are investors who keep on investing on long-term basis. So broadly, you can say these are the various category of participants in the market: SEBI, exchanges, broking houses, traders, and investors. Is it clear to you up to this? Up to this, did you understand?
Yes, sir.
Well, friends. Now, as I told you, SEBI is the regulatory body. It keeps an eye on the functioning of the stock market. Right? As you have seen, right now we have visited the SEBI website. You have seen how it recognizes the stock exchanges, how it gives licenses. Okay, so all these processes are there. You can go to the SEBI website, you can understand how it regulates. Various guidelines they issue as regards to secondary market. And the stock exchanges, like we have seen just now, we've seen the 9 stock exchanges are recognized as of now. They facilitate this transactions of buying and selling. Broking houses helps the investor to trade on the exchanges. These brokers are registered with Security Exchange Board of India. Okay, they are only authorized to help you or to assist in the trading. So as an investor, you have to do it through a broking house. Traders are investors are the individuals who buy and sell their securities. Okay, when you say investors, normally we refer to those people who invest on long-term basis, and traders who participate in the market or buy, sell on short-term basis. Okay, now coming to this kind of traders and investors. As you know, or just now we are discussing, the market fluctuates. Sometimes you might have seen the market continuously goes up. Yes or no? That situation is referred to as, can anyone tell me when market goes up continuously, market rises, what do we call it?
Bull market.
Bull market, or market becomes bullish. And when market continuously goes down for some time, then we call it
Bearish
market. So bull and bear. So on that basis, many times broadly we classify those investors as traders. Some of them are bulls, some of them are investors. So that's why we say these are the two major animals. They operate in the stock market. Some of them are bull, some of them are bear. So not only bull and bear, other animals or other birds, these people are also there in the stock market. So we can classify these investors or traders. Some of them we can call them as just a minute. Picture is not appearing. Okay, we can call them as bulls. Bulls means they feel that market will go up. When the market will go up means prices will be going up, and prices will go up. They always keep on buying. They create buying this. They keep on buying. They feel that price will go up today. Suppose you have purchased at 10 rupees, maybe after some time it will become 12 rupees, then 13 rupees, like this price will go up. They are called as the bull. And if price actually goes up, then will happen. And there are many people who create selling pressure. They feel, okay, today it is, let us say, 12 rupees, tomorrow it will become 11 rupees, so let me dispose of my stock today. So their behavior is bearish. They try to sell their securities. Okay, they create selling pressure in the market. We can refer to them as bear. Okay, so there might be either bulls or bears. In addition to that, there are again you can say group of participants. We call up them as stags. Stags means you can say they are the smart investors. They always buy when the price is low and sell when prices are high. They are called as the stags. There is one more category of investor which you can call it the lame dogs. Lame dogs, what they do, they are the losers. Right? They always buy when prices are high and sell when the prices are low. So they are the losers. So like that, investors can be classified bulls, bears, stags, and lame dogs. Okay, now let us understand few more things, and yeah, let me cover that thing also. Before yeah, let us first understand the trading mechanism, then we'll go to these various trends like bullish trend, bearish trend, how these fluctuations are there. Now let us see how one can trade, how these bears, bulls, lame dogs, or stacks, they participate in the market. For that thing, what is required to do the trading? You need basically one demat account and one trading account. The companies, they list their shares or they list their securities after IPO. When initial public offering is made, after that securities got listed. So once a security is listed, that means it's available for trading in the secondary market. It can thereafter, but it can be bought and sold in the secondary market. And why they're traded, why they're bought and sold in the market? Because for two things: people want to make profit. People buy shares because they feel prices will go up, they'll be able to make profit out of this. Or they also sometimes, in order to cut down their losses, they feel that there is enough loss, they dispose of the shares. So they trade, buy and selling happens because of this thing. Buying happens normally to make profit and selling happens to cut down losses. And all this trading that are done by people has to be done to stockbroker or a brokerage firm. These brokerage firms or the brokers, in fact, act as an intermediary between the investors and the stock exchange. They help in the trading process. Okay. Okay. Now, just a minute. Yeah. Now, just now I told you this thing that one demat account and trading account is required. Now we need to understand in that context what is demat. Demat account is an account which holds the shares and securities in the digital form or in electronic form. Handling physical shares is a difficult task. Therefore, shares and securities are held in digital form. Okay, varieties of other kind of securities like bonds, mutual funds, government securities can be held in a demat account. So if somebody wants to participate in the secondary market, it is expected that he should have a demat account first. And the process of converting these physical securities or physical certificates into electronic certificate is called as the dematerialization. Okay, so you can say dematerialization, the process through which physical securities such as share certificate and other documents are converted into electronic form and they are held in demat. If someone wants to trade, then his share certificate needs to be held in dematerialized form in a demat account. Therefore, one needs to open a demat account first. And what is the demat account? Who maintains the demat account? To understand that thing, we need to have idea about one more concept, that is who is a depository and who is a demat depository participant. These demat accounts are maintained by the DP, which are called the depository participant. Now question comes, who are these DPs? DPs are in fact the agents of the depository. Now you might be thinking, who are these depository now? You can say depository is a body who is responsible for holding the securities in electronic form. Let us say you are opening a demat account. So your securities are held in electronic form. Now, who is responsible for maintenance of that account? It is the depository who is responsible for maintaining that account in demat form or in electronic form. And in our country, as of now, there are only two depositories. Okay, you can read who are them. One is NSDL, second is CDSL. Okay, NSDL stands for National Securities Depository Limited, and CDSL stands for Central Depository Services India Limited. So these are the two depositories, and these two depositories has got many agents. They are called as the depository participant. And these demat accounts are handled by your depository participant. Is it clear? And your securities, be it equity, be it bond, be it government securities, are held in demat form, and it's maintained by this depository participant. And it's a depository who is responsible for maintaining all these things. Is it clear to you?
Yes, sir.
Okay, good.
Yes, sir.
Now, let us understand the process of, once you know the securities are dematerialized or securities are held in electronic form, let us first theoretically understand how these purchases and sales happen in this dematerialized securities. Okay, so these are the steps. First of all, purchase of dematerialized securities. Let us see it one by one. Step one, you have to select a broker who can facilitate the purchase of the securities. So there are many brokers, okay, in our country. So you have to find out your own broker. You have to open an account with him, that he will be doing your purchase and sale of securities. Okay, you can find out who are the brokers available, a broker or sub-broker, you can find out. Then what will you want to purchase? Then you need to make a payment to the broker, who will arrange for payment to the clearing corporation on the pay in date. That means you have to make payment to the broker, and broker will be making payment on your behalf. Then next step, what is going to happen? The securities you want to purchase, mind you, the securities are credited to the broker's clearing account. It is a clearing account which is maintained by the broker. Suppose you want to buy and you have paid money to the broker. Now securities will be first credited to the broker's clearing account. Then what the broker will do? Broker will give instruction to the DP to debit the clearing account and credit the same to your account. Now you are having a demat account. Now securities has arrived as the broker's clearing account. So now broker's clearing account will be debited, and your demat account, which you are maintaining with your DP, will be credited. Thereafter, the depository will confirm the dematerialization of shares to the DP. Depository will confirm that shares in dematerialized form has been credited. Once it is done, a credit of holding of shares will reflect in the investor's account electronically. Investor's account will show that these accounts are credited, and investor will receive the shares in his account. Okay, in order to receive the credit, investor need to give a receipt instruction to the DP, and if the investor didn't give standing instruction during the opening of account, then this receipt instruction has to be given on a regular basis. So this process is like this. Once again, I repeat. So when you want to purchase, this has to happen through a broker, and shares will be coming to your DP account through that broker's clearing account. Okay, and you need to pay the money to the broker. Broker will charge some commission. This is the process of purchasing dematerialized securities. Now, if you want to sell some dematerialized securities, now these are the steps which needs to be followed. Let us see this thing also. Selling also will happen through a broker. So you need to find a broker first of all. Then the DP needs to be instructed to debit your account with the number of securities sold and credit the broker's clearing house. Now, DP, you have to, through broker, you have to give instruction that your accounts, that means the securities which are appearing in your demat account, needs to be debited, and it should be credited to the broker's clearing account. So demat account is just like your bank account. See, instead of money, your securities are here. So now your demat account will be debited and broker's clearing account will be credited. And you need to send the delivery instruction to your DP for delivery. You have to give the instruction that it has to deliver. Once the request is approved, the share certificate is physical form. If it is already in the physical form, it is to be destroyed, and this dematerialized certificate, or you can say dematerialized securities, will be transferred. Broker will give instruction to the depository participants for delivery. And once these are delivered, you will receive the payment. Meaning, if I summarize this process, if already it is in the demat securities are reflected in your demat account, so you have to instruct your broker, and through that you will be communicating to the depository participant that your account needs to be debited and broker's clearing account needs to be credited. And once delivery instruction is approved, then you will be getting payment. That is the process of selling up demat securities. This process we can understand with the help of this chart. At the top you see, the top part if you see, it talks about the flow of funds, how money moves. At the bottom part you see flow of shares. And for buying as well as selling, you need to involve brokers. Okay, buyer has a broker, seller is also having a broker. And there may be two different brokers. Okay, when buyer wants to buy, first you see flow of funds. Buyer has to give money to the broker. Broker has to give money to the stock exchange. Stock exchange has to give money to the seller's broker. And seller's broker has to give money to seller. Now seller has got money, buyer has given money. This is how it is good. And how share will flow? Seller will transfer the equity shares or whatever may be the securities to the broker's clearing account. Broker will transfer it to the stock exchange. Stock exchange will transfer to the buying broker's clearing account, and the buyer's broker will transfer it to the buyer. So it will be reflected in the buyer's demat. This is how funds flow from buyer to seller, and this is how shares flow from seller to buyer. Hope you have understood it. Right?
Yes.
Now, the same process is explained in this slide. Whenever you want to buy, you need to place the order with the broker at a fixed price. Broker passes the order to the stock exchange. The exchange searches the availability of the buyer and seller. Exchange searches who are the buyers and who are the sellers to execute the order. If your demand matches supply, automatically order is executed. Suppose you want to sell 100 shares at 200 rupees and someone is interested to buy 100 shares at 200 rupees, and the buying and selling quantities and amounts matches, the order automatically gets executed. If the order is completed, then the exchange communicates it to the broker that order has been executed. Stock exchange keeps a record of all these details of the buyers and sellers who are trading these securities. Stocks are thereafter transferred to the demat account of the transferred from the demat account of the seller to the demat account of the buyer electronically. This process of transferring from one demat account to another demat account is called as settlement. These days, settlement takes T plus 2 days. T plus 2 days means today plus 2 more working days. Within that, settlement normally happens. This is the trading process. But whenever we are participating in the market like this, you have to understand certain caveats or certain warnings. You need to first of all understand what is yours, that is what is the investor's risk bearing capacity. How much of risk one can afford to take. Already you know the stock market is a market where value is highly fluctuating. It keeps on fluctuating. Price goes up and price comes down. So if price comes down, that means it will be incurring losses. How much of loss you can absorb, you need to know that. On that basis, you need to take your investment decision. So you may do a kind of risk profile analysis or you may seek for some professional help or some consultant helps to understand the risk profile. So earlier, previous classes, I had shown you some of the prospectus in relation to IPO. And if you see the prospectus, if you go to the website, you can download the prospectus of some company. You can find out the risk profile is explained in that prospectus. So you need to read that, understand what kind of risk the company has or that securities have. One may seek the knowledge from the experts, financial experts, or from certified investment advisors before participating in the market. So this care one is to take. So friends, this is about certain basics about trading mechanism and trading process and online trading, how it will happen. We'll be learning in our next session. So I hope after this you have understood. Yes or no? Did you follow it? Whatever you have understood the basic process.
Yes, sir.
Okay then. Thank you, friends. We'll stop here. We'll again catch up with next session with a different topic. Thanks a lot.
Thank you, sir.